Hi, and welcome to this week's market presentation.
Latest news.
In the latest developments regarding the war in Ukraine, the United States introduced new sanctions against Russia's largest oil producers, Rosneft and Lukoil, which combined exported roughly 3.1 million barrels per day of crude oil. Rosneft alone accounted for nearly half of all Russian oil output. On top of the imposition of new sanctions against Russia, the Trump-Putin summit that was to be held in Budapest was officially canceled, reducing the prospect of additional progress on a peaceful end to the war. We've already seen the impact on global oil markets, with China's state oil companies announcing they were pausing additional purchases of Russian crude oil, potentially reducing those purchases by as much as 500,000 barrels per day. India's refiners have also begun scaling back Russian oil imports as those importers look to avoid the imposition of secondary sanctions by the US. Overall, as Russia is able to export less and less oil globally, and as China and India move away from Russian crude, we're likely to see more stringent competition for alternative sources of oil. We've already seen the impact on prices, with Brent jumping up from $61 per barrel up to $66 per barrel on those potential supply disruption concerns. On the European side of things, the European Union announced the 19th sanctions package against Russia. In this latest sanctions package, it will accelerate the Russian energy exit by European countries, with a complete ban on Russian LNG stated to take in effect on January 2027. There will be a two-phase implementation, with short-term contracts being forced to end within 6 months and long-term deals by the beginning of 2027. Overall, this is expected to have a slightly bullish impact on markets, especially in the shorter term, where we could see short-term disruptions and uncertainty due to some of the legal complexities in being forced to terminate contracts. Nonetheless, looking into longer term, we do see that the European Union will have to shift its demand towards the US and Qatar, which are both significantly growing their export capacity. Moving on to the trade tensions between the US and China, we see progress being made in tamping down those tensions, with a brighter outlook regarding the relation between the two largest economies in the world. The US and China have agreed in principle to a comprehensive trade framework. The US has agreed that it will no longer be threatening to impose an additional 100% tariff on all of Chinese imports into the US. In exchange, China stated that it would resume the purchases of US agricultural products, especially products such as soybeans, as well as delay the imposition of its rare earth export controls that were announced previously by 1 year, as well as finalizing some of the deals regarding the sale of TikTok. There's still more to be discussed, and that will take place during the face-to-face meeting between President Trump and President Xi Jinping in South Korea. Most importantly are the demands by China that the US relaxes additional tariffs that President Trump imposed against Chinese imports, as well as relaxing some export controls that the US put into place. Overall, global equity markets rallied on the reduced trade war fears between the largest economies, with energy markets also reacting positively, particularly on the back of improved demand expectations.
Weather.
Weather forecasts across Europe are now indicating above average temperatures over the next 7 to 10 days, particularly through the middle and end of this week. Precipitation forecasts have similarly been favorable, particularly in the Nordic region, with higher levels of precipitation expected to improve the hydropower outlook there. Lastly, in terms of average wind speeds, we'll continue to see high wind speeds, particularly across Central Europe over the beginning of this week, although that is then expected to begin to ease as we move to the second half of this week and early next week. Lastly, Hurricane Melissa, and now a category 4 hurricane, emerged in the middle of the Caribbean, and it's expected to move through Jamaica and into Cuba and then into the Atlantic. So far, its projected path does not put it in place to negatively impact U.S. oil and gas production or U.S. LNG export activity, although yet to be seen if the modeling will prove correct.
Microeconomics.
Inflation figures for the month of September were released for several key economies. Most notably is the U.S. inflation figures, which showed a relatively stable evolution for inflation over the past month. Year-over-year inflation remained relatively stable at 3% for the previous month, while core inflation came down slightly and remained now at 3% over the previous month. Overall, inflation came in cooler than anticipated by many. However, it's still notably above the 2% target set by the Federal Reserve. Over in the UK in particular, we see inflation remaining sticky at quite elevated levels, with year-over-year inflation at 3.8% and core inflation just slightly below that at 3.5%.
Crude oil and LPG.
Crude oil prices rebounded over the past week, primarily on the back of the imposition of tariffs by the US against Russia's largest oil producers. The imposition of those sanctions is expected to tighten global oil supply and demand balances. On the supply side of things, adding to this bullish sentiment was the announcement by OPEC Plus that it is looking into pausing additional production quota increases in the next month. On the demand side of things, while markets continue to be weighed down by lower demand expectations due to the impact of the US tariffs on the global economy, but nonetheless, the positive movement in reducing trade tensions and friction between the US and China did lend a boost to future demand expectations. Overall, market expectations remain to be on the oversupplied nature, with the EIA still predicting an oversupplied market throughout next year. Goldman Sachs now predicts that crude oil prices will dip below $60 per barrel throughout 2026 due to that as well.
Natural gas.
Natural gas prices over the past week remained relatively stable week over week. The front quarter moved up by just 1.2% on the week, while the front year pricing moved up 1.5 percentage points week over week. Overall pricing remains on the lower end that we've seen over the last few weeks, down around 3.5% compared to a month ago and down almost 8% over 3 months ago for the front year product. Looking at the fundamentals, the level of injections into storage moved into positive territory over the past week, following that previous week where we saw net withdrawals across Europe. Nonetheless, the injection rate remains near the lowest levels in over 10 years, in line with where we were last year, although last year storage levels were notably higher than they are currently. Storage levels ended last week at just under 83%, in line with where we were a week and a half ago. Overall, we're still below the 90% mandated target by the European Union, and compared to last year's levels, we're still seeing a deficit of roughly 12%. The main country still below the European average is Germany at just 75% full. Looking at total demand of natural gas, we did see a slight dip in demand levels across Europe, pushing total demand below the past 5-year average. On the other hand, total supply continued its gradual improvement, although slightly more slowly than in previous weeks. Taking a closer look at the supply mix, we note the stability in Norwegian gas flows once again above the 300 million cubic meter per day level, while LNG sendouts saw a slight dip over the past week, although they did remain near the highest levels in over 5 years. LNG imports continue to move towards Europe, with imports into Europe at a 7-month high, with the share of global exports going to Europe now at the highest levels since early this summer. One of the main reasons for the improved outlook for LNG imports into Europe has been the limited price competition with Asian consumers. A big reason for that is the lower demand for LNG from China due to the high LNG stocks in the country, as well as the sourcing of LNG from Russia's sanctioned Arctic 2 LNG terminal.
Coal.
Looking at coal prices next, we see limited movement over the past week, particularly looking at European coal prices. It must be noted that European coal prices are already nearing the levels where we're looking at producer margins being met. And as a result, we do see limited downside for coal prices looking forward. Overall, we do continue to see ample coal stocks at ARA terminals. And then we also see lower overall demand for coal across Europe. The main reasons for the weaker demand for coal are one, weather-related, with favorable weather conditions reducing demand for coal. But the other factor is that power sector demand is being weakened by the lower gas prices and high carbon allowance prices, increasing some coal to gas switching, and the improved renewable energy outlook further reducing power sector demand.
EU and UK emission allowances.
Looking at carbon allowances, we see a slight decrease in the price level on the European and UK side, with European prices down 1.2% on the week and UK prices down 3.2% on the week. Nonetheless, current prices in the UK and in Europe remain near the highest levels we've seen all year. And the main driver of that bullish sentiment are the tighter market expectations for 2026. The main reasons for the tighter market expectations are a reduction in the level of allowances, given the end of the Repower EU front-loading, which saw a temporary increase in the supply of allowances starting in 2023, which is now set to end in August of 2026. We're also seeing the progressive phase out of free allowances for CBAM covered sectors, as well as an increase for compliance obligations as full coverage of the maritime sector and the end of free allocation for the aviation sector is set to take place in 2026. This shows some uncertainty and some potential downside to this bullish outlook that is currently holding the market, particularly looking at macroeconomic weakness across the euro area, which could see worse economic performance dampen industrial activity and in turn the demand for allowances. Lastly, looking at the power sector, we could see a further improvement in the outlook on output for renewable energy, reducing power sector emissions, but overall yet to be seen. Overall, we continue to see bullish sentiment in the market as seen by the level of net long investment fund positions in the market, with European net long positions at a record high and UK net long positions near a record high.
Electricity.
Before moving on to electricity, I would like to note that due to an issue with our data provider, we are only able to show more limited market data for this week. We're working on resolving that as soon as possible. Moving on to then electricity prices across Europe, we see the price for German electricity remaining relatively stable over the past week. The front quarter decreased by just around 1.7%, with the front year down just under 0.8 percentage points on the week. Looking at European markets across Europe, we see a similar price evolution, particularly across Western Europe, with relatively stable prices over the past week. One exception being France, where an improved nuclear outlook has added some more bearish sentiment to the market there. Over in the Nordic region, we see the wetter weather forecast that we saw earlier in the presentation add additional bearish sentiment to the market as it is improving the hydropower outlook in the region. Lastly, looking at guarantees of origin, we note a little more limited movement over the past week compared to the large decreases we saw over the previous couple of weeks. The bearishness continues for 2025 year production guarantees of origin, with prices coming down noticeably, especially when it came to hydro, wind, and solar guarantees of origin. Further along the curve, we see more stability with more limited movement over the past week, but nonetheless, looking at pricing for guarantees of origin near the lowest levels we've seen since at least September 2024. That covers 6 weeks markets presentation. Thank you for joining.